What's up, everyone? The stock market is going absolutely parabolic right now, and frankly, it's getting a little scary. According to financial experts like Peter Grandich, we've officially that final euphoric surge before a potential stock market crash. We're seeing the S&P 500 up 30% year over year, and the Shiller PE ratio is hitting levels we haven't seen since the peak of the dot-com bubble. Is this a once-in-a-generation opportunity to build wealth, or are we standing on the edge of a financial crisis? Today, we're looking at the data, the history of the 1929 stock market crash, and the Japanese asset price bubble to see exactly where we stand. Welcome back to the Dollar Pilot. I wanted to make this video today because I'm getting tired of the highly edited, over-scripted content. We need to talk objectively and openly about what the economic data is actually telling us. Right now, the investing world makes almost zero logical sense. We have unresolved conflicts in the Middle East, inflation pushing gas prices through the roof, and the cost of living is skyrocketing. Yet the stock market index just keeps hitting new highs. It feels like Wall Street is detached from reality. A lot of market analysts are comparing today's United States to the late 1920s, right before the Great Depression. If you overlay the historical stock market charts of the 1920s with the market action of the last 30 years, they track almost perfectly. We could be in the final stages of a massive market bubble before a painful market correction. Take a look at the Japanese everything bubble of 1989. For nearly 2 decades, Japan saw non-stop exponential growth fueled by low interest rates and massive borrowing against rising real estate values. People thought it was the new normal until the market saw a 50% plummet and didn't recover for nearly 40 years. Today, we are seeing similar red flags. The Buffett indicator is currently 2.4 deviations above its historical trend. The market concentration is also extreme. The top 10 tech stocks now make up 40% of the entire S&P 500, which is even higher than the peak of the internet bubble. The S&P 500's forward PE ratio is currently above 28, while the 100-year average is only 17. This suggests that either companies need to start making significantly more money very fast, or stock prices are going to have to fall. There are 3 main arguments for why we might be in a stock market bubble. First, stocks are incredibly expensive relative to their actual profits, leading to concerns about overvaluation. Second, the U.S. is facing major demographic shifts, a declining birth rate and an aging population, similar to what triggered Japan's economic stagnation. This puts a massive burden on social programs and taxpayers, forcing the government to keep interest rates low and grow national debt faster than the economy just to keep things moving. Third, we are seeing a decline in organic savings and a high dependence on AI-driven productivity to offset a shrinking workforce. If the market fundamentals don't support these high valuations, a market crash isn't just possible, it's inevitable. However, we have to look at the other side of the investment strategy. Unlike the dot-com era, today's tech giants, the Magnificent Seven, are actually generating massive amounts of revenue. Companies like Nvidia, Microsoft, and Alphabet have genuinely impressive cash flows that exceed their income. Their net profits are well above their 5-year averages, proving they are highly profitable businesses. Fidelity recently noted that while the CAPE ratio is high, forward earnings are still below the 2001 peak. Plus, what is the alternative for your portfolio? If you hold cash, you are guaranteed to lose purchasing power to inflation. Over the last 20 years, cash has lost an average of 1.8% in value per year. This forces investors to take risks in equities because there is no alternative. No one funds or infrastructures, a phenomenon often called the Tina effect. So, what should you be looking for? Warning signs include companies burning through cash faster than they make it, extreme debt levels, or AI infrastructure hitting a limit due to energy constraints. But many believe that artificial intelligence will actually scale the economy by helping smaller firms, healthcare technology, and utilities become more efficient. If companies deliver on their earnings reports and political tensions stabilize, the bull market could move even higher. Even if you invested at the very peak in 1929 and held through the crash, you would have still made an 11% profit from dividend investing alone over the next 20 years, assuming you never sold. The biggest mistake investors make is trying to time the market perfectly. Take the story of Isaac Newton. During the South Sea Bubble of 1720, he invested and made a profit, but then he saw his friends getting even richer. He panicked, bought back in at the absolute peak, and lost everything when the market crashed. He famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." Don't let that be you. My approach here at the Dollar Pilot is simple. I remain diversified across US and international markets. I keep about 20% on the sidelines in treasury bills as a sleep at night fund, but I continue to dollar cost average. The market can remain irrational longer than you can remain solvent. Don't try to be a genius, try to be disciplined. Those who have blindly practiced DCA investing over the last decade have done far better than those trying to predict the next stock market correction. Stay the course, keep your income steady, and remember that a market dip is just a long-term buying opportunity.